Hello dear students, welcome to Devika's Commerce and Management Academy. So today we'll see one problem where purchase consideration is not given. Acquisition of business chapter, purchase consideration is not given. We have to find out. How to find out? Net assets method I told you on the very beginning day, introduction day. So net assets method means all the assets minus liabilities. All the assets minus liabilities. What kind of liabilities? Liabilities which are related to the outside liabilities. Then you will be getting the purchase consideration. Okay. So as for that, we are going to work out problem. Very important problem. The problem is given on the desktop. You can write down or note down. First, let me explain this problem. Then after that, we'll go for calculation. The problem is given like this. BK Limited registered with a capital of 10 lakh rupees in equity shares of 10 rupees each. 10 lakh rupees, each share is 10 rupees. It means how many shares are there? 10 lakh divided by 10. It means 1 lakh shares. Okay. Each 10 rupees each acquired the business of Prem Brothers. BK Limited registered with a capital of 10 lakh rupees in equity, 10 rupees each, acquired the business from Prem Brothers. Means BK Limited is purchasing company, Prem Brothers is the vendor. The balance sheet of the firm at the date of acquisition was as under. Now if you see the balance sheet, you can find on the asset side cash, bills receivable, investments, debtors, stock, furniture, machinery and premises. On the liability side, bank loan, creditors, reserve, capital. Outsiders loans are bank loan and sundry creditors. Reserve is and capital. Now coming to the adjustments, the assets and liabilities were subject to the following revaluation. Generally, assets and liabilities revaluation was not given in the last problem. Now here revaluation means more or less some alterations are given to these adjustments. That we have to consider it, just like final accounts. Simple final accounts, what we used to do in the same fashion. Now what are they saying? First, EBIT is machinery and furniture to be depreciated at 10% and 15% respectively. Okay, depreciation on machinery and furniture. Second bit is premises should be appreciated by 20%. So machinery, furniture, depreciation, premises, appreciation. Appreciation means will be adding. Next, make provision for bad debts on debtors is 2.5%. This is also deduct from the debtors. Goodwill of the firm is valued 24,000. Generally, goodwill will be given in the balance sheet. Now here they are saying in adjustment goodwill value also we have to consider it. Generally, when we pass the second entry, assets and liabilities are taken over. For that, there we were going to get balancing figure, either goodwill on the debit side or general reserve on the credit side. Now here goodwill is given. Okay. The next, EBIT, the purchase consideration was to be discharged as follows. Purchase consideration. Purchase consideration, first of all, we are going to calculate whatever amount you are going to get, that is to be paid as follows. How we are going to pay? Allotment of 10,000 equity shares of 10 rupees each at 12 rupees each. Actually, we wanted to pay to 10,000 rupees of equity shares at the rate of 10 rupees. And 12 rupees they are saying 12 rupees is the difference, 12 rupees minus 10 rupees, that is premium. Here premium is hidden, they are not saying it, it is understood. Share value is 10 rupees but they are paying it at 12 rupees, means with premium they are paying it. Next, allotment of 500, that is 10% debentures, 100 rupees each at a discount of 10 rupees. Here debentures are 500, each debenture is 100, means 50,000 we have to pay, but this is at the discount of 10 rupees they are saying. Just remember this transaction, while working out I'll explain this. And the balance in cash, same like previous problem, we are paying equity shares, debentures and rest of the amount in cash. You are required to show the journal entries in the books of the company and prepare balance sheet. Problem already I have done. I'll explain it because it will take very lengthy and lots of time for working out and showing you. So first of all, purchase consideration is not given in this problem. Purchase consideration we have to find out. How to find out? This is net assets method. In net assets method, generally whenever purchase consideration is not given, we have to take all the assets, all the adjusted assets minus outsiders liability. So this point you remember. Working notes. Okay. Calculation of purchase consideration. This is as per the net assets method. Calculation of purchase consideration. What we have to take? We have to consider all the assets. What are all the assets? You see, first we have some adjustments. Adjustments, you can just put a tick mark near to the asset. Like machinery, furniture adjustment is there near machinery and furniture. I already kept a tick mark. Premises, there also you put a tick mark so that you will not forget. And debtors also there is an adjustment. Goodwill, remember that we have to consider it. First, we'll take all the assets. Cash is as it is 29,000. Cash is 29,000. Goodwill, don't forget. So that is why I have written on the top only. Goodwill, okay, which is given in the adjustment. Now coming to the assets, cash as it is 29,000. Bills receivable 10,000. The next investments 3,000. Then debtors. Debtors are adjustment is there. How much? Make a provision for bad and bad debts or debtors 2.5%. 48,000 is the amount. 48,000 minus 2.5. 48,000 minus 2.5, you will be getting 46,800. Okay. Next stock 18,000 as it is. Whenever adjustment is there, that will do. Otherwise, as it is will write. Stock 2,000. Furniture 2,000. Furniture is 15%. Furniture 2,000 minus 15%, it comes to 1,700. Machinery 10%. 40,000 minus 10% comes to 36,000. Okay. Next, premises 50,000. Premises is appreciation. So 50,000 plus 20%. 50,000 plus, how much is the appreciation? 20%. By mistake I wrote 12%, it is 20%. So 10% comes to 5,000. 20% means 10,000. If we add 10,000, it is 60,000. All the assets we have written. All the assets adjusted. Adjusted assets minus outsiders liabilities. What are the outsider liabilities? You can find bank loan and creditors. Only two. So that we have deducted. Creditors and bank loan. So you are getting 1,82,500 is the purchase consideration. First thing, we found the purchase consideration. Then we can write the journal entries, because first journal entry is, business purchases account attached to vendor account. Vendor is here Premchand, right? So for purchasing the business purchase account attached to Premchand account. What do you write? Purchase consideration amount only. So that we got it, then only we can start the journal entries. Right, first entry we have written business purchase account attached to vendor Premchand account. So this is the same amount, 1,82,500 is written, being business purchase consideration. Okay. Next, second one, what to do? Assets and liabilities are taken over. Assets and liabilities taken over. The entries, various assets account attached to liabilities to business purchases. This we have to cancel on the credit side. We know this entry. What do we do? Debit side, all the assets, various assets separately. Whatever we have taken, everything we are writing here as it is, debit side. See, goodwill 24,000, cash, bills receivable, investment, cash, bills receivable, investment, debtor, stock, furniture, machinery, debtor, stock, furniture, machinery, premises. Okay, everything as it is, all the assets written on the credit side, debit side. Credit side, what do you write? Liabilities, outsiders liabilities. Outsiders liabilities already we have written here, 36,000 and 10,000. Only two outsiders liability, not shares or reserves. So this will be on the credit side. And also credit side will be cancelling this business premise purchases account. So two business purchases account, same amount, 1,82,000. If you total up, both the sides is equal. Generally in the previous problems, we used to get balancing figure. Balancing figure, if it is on debit side, that will be goodwill. If it is on credit side, that will be general reserve. Okay, reserve you will be getting. So here nothing is there, same, both the sides are equal. Narration being assets and liabilities taken over. Okay, then after the third entry is, what is the third entry? Paying off. Pay off this 1,82,000. How do you want to pay off? So they gave it in the EBIT. The purchase consideration was to be discharged as follows. Now here 10,000. First of all, we'll write we are paying it off to vendor. Vendor's account attached to. However, you are paying it. It comes on the credit side. Vendor is the receiver. Who is the vendor? Premchand, Prem Brothers. So Prem Brothers account attached. Remember this. We want to pay it to him 1,82,500. Okay. How do you want to pay? Allotment 10,000 equity shares, 10 rupees each. 10,000 equity shares, 10 rupees each means this one, equity shares. And allotment of 500 debentures, 100 rupees each. Now here, actually amount is 10 rupees, but we are paying it off to 12 rupees, means the difference 12 rupees minus 10 rupees is premium. Premium also we are paying now, so we are showing it separately. Share premium account, shares are 10,000 at the rate of 2 rupees. 2 rupees, how do you got? 12 minus 10, 2 rupees. So we are writing separately share premium also. And debentures 500 into 10, this is you know. And this debentures at a discount of 10 rupees. Allotment of 500, 10% debentures, 100 rupees each at a discount of 10 rupees. We are giving discount. Discount is a loss. So all the losses will be on the debit side of the same entry. So we have written discount on debentures. How much is there? 500 into 10 rupees. So this is 500 into 10 rupees. 5,000 we have written on the debit side. 5,000 we have written on the debit side. And balance is cash. Balance in the sense 1,87,500. This debit side total is how much? 1,87,500. Actually 1,82,500 only we would have written. 5,000 is loss. Discount we are giving on debentures. So we are writing loss on the debit side. So this comes to 1,87,500. That minus all this 1 lakh and share premium 20,000 and debentures 50,000. So if you deduct all these things, you are getting cash of 17,500. This is balancing figure. Paying off the amount to vendor. This is paying off. And there is discount. This discount has to be written off. Discount on debentures. When though they are not saying every time discount on anything, discount on debentures or discount on any other amount, it has to written off. Written off means this debit one comes on the credit side. Okay. So this comes on the credit side. Debit side, what do you write? Share premium account. Written off by sending it to the share premium account. Share premium account attached to discount on debentures account. How much is the discount? The same one, 5,000 only we are writing. Are you getting it? 5,000 we are writing. 5,000 debit side discount on payment as a loss we have shown. That loss is transferred to the share premium account. Discount on debentures debit and here credit. It means it is cancelled. Debit side and credit side we are writing. It got cancelled. Means it doesn't affect at all. As we have written on the debit side and also cancelled it by writing written off entry. Are you clear? So with this, journal entries are over. Journal entries and working notes. Now coming to balance sheet. Balance sheet, you know the format. Now how we have posted this balance sheet, you see. First of all, share capital. Share capital which is given in the balance sheet. So this is first bit, E transaction, first bit. Allotment of 10,000 equity shares, 10 rupees each. At premium we don't consider. Premium comes under the reserves and surplus. Now right now share capital, that is equity shares are 10,000 equity shares at the rate of 10 rupees each. 10,000 at the rate of 10 rupees means it is 1 lakh. 1 lakh we are writing here. 2 rupees is there, no? That is, we consider it as a premium. That premium is, we consider it as a reserves. Because premium is extra amount. That will be transferred to the general reserve. So, under reserves and surplus column, we are showing that premium. Premium is how much it is? 10,000 shares. Actual cost is 10 rupees. And each one is 2 rupees premium. 10,000 into 2 rupees here. This comes to 20,000. How do you got 20,000? 10,000 shares at the rate of 2 rupees. So, share premium. For that, there is an adjustment. Discount is there. Discount, how do we pay this discount? From the premium. Premium means profit. Discount is loss. Right? So that is why from this we are deducting the discount and debentures. Discount and debentures is this much, 5,000. We are deducting here. So total how much we have reserved? 15,000. If discount was not there, then we would have returned 20,000 directly. But there is a discount loss is there. Because of that loss, reserve is decreasing to 5,000 rupees. So 20,000 minus 5, it comes to 15,000 we have written here. So share capital, you got it 1 lakh, reserve is 15,000. Then after that, long term loan. In the balance sheet it is not given long term loan, but in adjustments we found that debentures. Debentures values how much? EBIT second one. Allotment of 500, 10% debentures at 100 rupees each. Debentures it is. So debentures we can say it as a long term loan. How much? 500 debentures at the rate of 100. It comes to 5. Here we are showing third bit. So 10% debentures 500 at the rate of 100, it comes to 50,000. So this we have written. Then after that, current liabilities. Current liabilities, if you see, balance sheet liabilities are current liabilities which are outsiders liabilities. We can find here creditors and bank loan. Both are outsiders. So simply you can say current liabilities. Bank loan is 10,000. Creditors are 36,000. Total is 46,000 we have written. The total of the liabilities are 2,11,000. Next we'll go for the assets. Assets, two types of assets we can say. Assets, non-current assets, current assets. Non-current assets means first one we'll say it as a intangible asset. Second one, tangible assets. Or tangible, intangible assets also we can say. Non-current assets, tangible assets. Tangible means fixed assets. Fixed assets we have furniture, machinery and premises. Only 3. So we are showing it in the note number 3. Furniture. We will take this one after deduction. Furniture is 1,700. 17,000. 1,700 it is. 1,700 furniture. Machinery is here 36,000. Then premises 60,000. After deduction amount we have taken. You know, as usual in balance sheet, final accounts balance sheet, what we used to do, any depreciation or appreciations are there, we used to adjust. In the same way, we have taken this 60,000, 36, 96,000 plus 1,700, 97,700. So this is tangible asset. Tangible assets we have written here. Then there is the intangible asset also. Intangible asset means goodwill. Goodwill is given in the adjustment. Goodwill is how much? Debit. Goodwill is 24,000. So intangible asset, in brackets I have written goodwill. Tangible, intangible assets are over. Okay. Next one, current assets. Coming to current assets. Current assets, we can say first of all, cash and cash equivalents are, later we'll see lastly. Inventories we found. Inventories. Inventories means stock. Stock is 18,000 we have written. We don't say stock, we'll say inventories. Then after that, trade receivable. Debtors and bills receivable, we'll show it as a trade receivable. Trade receivable. This is 6th point. Trade receivables means bills receivable and debtors. Bills receivable 10,000, debtors after the bad debts 46,800, total is 56,800. 56,800 we have written. Then after that, Investment is there. Investment 3000. Less amount. Now we assume that it is a current liability, short term investment. So that is why I have written here. And now coming to cash and cash equivalents. Cash and cash equivalents in note number 7 we are showing. Actual cash is how much as per the problem? 29,000, which is given in the balance sheet. 29,000 is given. Out of 29,000 we have paid off 17,500. 17,500 already paid, means leftover cash only we consider. So this is given in the balance sheet, already paid 17,500, that you deduct it, you are getting 11,500. This is the cash leftover in the company, means balance sheet will be showing 11,500. Here 11,500 total up. Here also you are getting 2,11,000, means problem got tallied. Very simple. I'll give you a recap. First take the screenshot. The problem is nothing to worry, only purchase consideration is not given. When purchase consideration is not given, how to find out? All the assets minus outsiders liabilities. Like this we have done. All the assets which are given in the adjustments also we have considered. Appreciation, depreciation, including goodwill. Everything we have total minus outsider liabilities. We found only two, creditors and bank loan. So deducted we are getting the purchase consideration. Once if you get the purchase consideration, first entry is business purchase account attached to vendor account. Vendor is here Prem Brothers. So this amount, purchase consideration amount we have written. Second entry is transfer of assets and liabilities. All the assets as it is you write. To outsiders liabilities. Outsider liabilities are, we know only two are there. That two we have written, and also cancellation of this business purchases, it comes on the credit side. Two business purchases. Now in this problem, debit side, credit side amounts are tallied. If less goodwill, already goodwill given, that is the reason it is tallying. Next, third entry is paying off the amount to the vendor. Vendor account at our vendor is Premchand account at our, to how you are paying it. We are paying through equity shares, 10,000 shares at the rate of 10 rupees. Ignore the premium. Premium we don't consider. How you are paying? Share premium separately we are showing here. Share premium 2 rupees. 10,000 shares into 2 rupees. And also debentures. Debentures are, first we are writing the debentures amount, 500 into each one 100 rupees. There is a discount. Discount is a loss, so we have written on the debit side. Discount on debentures. How much is the discount we are giving? 10 rupees. 500 shares into 10 rupees. We have written on the debit side. So balance is paid through the cash. Balance in the sense 1,87,500 minus all these three. You are getting 17,500. We are paying through the cash. Fourth entry, extra entry we are getting. What is that? Discount and debentures we wanted to transfer it to the share premium or written off. So for the discount, debentures comes on the debit side, sorry, credit side. Discount and debentures comes on the credit side. Debit side is share premium. Both the sides it got cancelled. Doesn't make, it's nullified. It doesn't affect at all. So this is over. This fourth entry we are saying being discount on issue of shares written off to share premium account. Over. General entries are over. Now balance sheet, just now I explained you. Balance sheet, first thing is that share capital. Share capital is how much share capital? We have only equity shares, 10,000 at the rate of 10 rupees. This is reserves and surplus is nothing but share premium. Premium is transferred to the general reserve. Okay, reserve and surplus. Extra, no? So there we are deducting the discount on debentures. This is profit transferring to the surplus. But discount on debentures is loss. Deduct it, then only you will come to know exactly how much surplus is there. So 20,000 minus 5,000, it comes to 15,000 written here. So where it is here. It is here. Then after that, long-term loan, which is nothing but debentures. Debentures 500 into 100, it comes to 50,000. Next, current liabilities. We have only two current liabilities we have written here. Next, current liabilities are over. So altogether 2,11,000. Now assets are current, non-current assets, current assets. Non-current assets means tangible, intangible. Tangible assets means we have three assets. After appreciation, depreciation, we have, this is the total 97,700. So it's written. Intangible asset is also there. Though it is not mentioned in the balance sheet, in adjustments we found that goodwill is there. So that we have written. Next, current assets. Current assets, various current assets we have to consider. One is stock. Stock means we don't say it as a stock, we say it as inventories. Inventories, trade receivable means bills receivable and debtors together. Trade receivable. Cash and cash equivalents we have shown here, and there is an investment also we have considered as a current asset. Now cash and cash equivalents, as per the balance sheet it was given 29,000. Out of 29,000 we have already paid 17,500. Deduct it. So you are getting 11,500 exactly in the balance sheet, to be shown in the balance sheet, 11,500. That's all. Nothing to worry. We know the procedure and everything. Only the thing is we have to be very careful. Purchase consideration is not given. What to do? We have to find out. So we found that. Then rest of the problem is more or less, apart from the discount and debentures, everything is normal. Try to work out this problem and take out your textbook. Whatever course you are doing, if you find any other problems, please work out it. Do not get scared. We know everything. And please do share these videos and also practice well. Good luck.